Mr. Ralph, shall we begin?
Yes,
Yes.
okay.
Okay. So everyone, so good day. Assalamualaikum warahmatullahi wabarakatuh, and good day to everyone. Good day to yeah. So good day to all students from Telkom University and University of San Agustin, the Philippines. So welcome back again to the online join class session 2 with the topic auditing and assurance concept and application. So today here we are with Ibu Elly Suryani and also Mr. Ralph Ian A. Braza as a USL lecturer, and then Bu Elly as a Telkom University lecturer. So today is our second session, right? So everyone, please kindly turn off the audio and kindly please turn on your video during the presentation. So for this occasion, Bu Elly and Mr. Ralph, who's going to be the first speaker?
Yeah, I'm the first one.
Okay, then. So,
Yeah, and then Mr. Ralph. Yeah.
yeah, so let's get the ball rolling then. To Bu Elly, please proceed.
Okay, thank you very much, Ibu Astri. Yeah, and good afternoon, Mr. Ralph. Welcome back here.
Good afternoon, ma'am. Good afternoon.
And my student and our student from University of San Agustin. Okay, thank you very much for this collaboration, for this opportunity, the joint class, yeah, online joint class between Telkom University and University of San Agustin. Okay, can I share my screen? Okay, wait. Okay, anybody can see my screen?
It's visible.
Okay, wait. Okay. Okay, anybody can see? Bu?
Yes, it's visible.
Okay,
It's visible, ma'am.
okay.
Yes, visible.
Okay, thank you very much. Okay, now the first I would like to present about the concept theory, just a brief theory about our topics, yeah, from the for this session, that audit of shareholders' equity. That was the first session last week, audit of liabilities, and now audit of shareholders' equity. Okay. So I have to again to remind you all, yeah, that what is our audit approach? Yeah, risk-based audit approach is referred to Aaron's that cycle approach. Yeah, there are 5 cycle in the final statement. Okay, sales and collection cycle, acquisition and payment cycle, payroll and personnel cycle, inventory and warehousing cycle, and last capital acquisition and repayment cycle. So, how about our topic today? Yeah, shareholders is part of the capital acquisition and repayment cycles. Okay. And then I have to remind you again how to methodology design of tests of the audit of financial statement. Okay, there are 4 types of tests in cycle approach of audit financial statement. Yeah, referred to Aaron's. The first test of control of transaction or TOC. The second substantive test of transaction is TOT. The third substantive analytical procedure is AP, and the last test detail of balance or TDB. Okay, and then to apply all of these tests, okay, again, you have to achieve our general audit objective. Okay, so this you have to know that management assessment have to align with our general audit objective. Okay, there are existent. Yeah, our objective is all the account. Yeah, all the transaction and the financial statement. It should be existence and a completeness. We have to test the accuracy, yeah, the valuation and allocation that's consists of accuracy, classification, cut-off, detail tie-in, realizable value, and you have to test the right and obligation and presentation and disclosure in the financial statement. Okay, yeah, this is the main test. Okay, we have to do. Okay, now how about the audit of shareholders' equity? Okay, audit shareholders' equity, yeah, it's part of audit capital acquisition and repayment cycles. Okay, there are two parts, yeah, in capital acquisition. Yeah, the first non-current liabilities, yeah, which was you learned last week, yeah, the session 1. Non-current liabilities is a part of the capital acquisition and repayment cycle. Consists of notes payable or long-term bank loan, bond payable, employment benefit liabilities. And the second part from the capital acquisition and repayment cycle is shareholders' equity. Yeah, consists of share capital, paid-in capital, return earning, dividend, and etc. Okay. Now, how about this cycle actually? The account of this cycle. Yeah, the capital acquisition and repayment cycle concern the acquisition of capital resources through interest-bearing debts and owner's equity and the repayment of capital. Okay, so there are 4 characteristics. Yeah, you have to understand, yeah, of this cycle influence the audit of this account. First, relatively few transactions, yeah, only few transactions affect the account balances, but each transaction is often highly material. 2, the exclusion or misstatement of a single transaction can be material. The third, legal relationship exists between the client entity and the holder of stock, bond, or similar ownership documents. So the legal document, okay? And fourth, a direct relationship exists between the interest and dividends account and debt and equity. Okay, this is the main thing about the shareholders' equity or this cycle. Now, how about shareholders' equity itself? There is an important difference, yeah. Please listen very carefully. There is an important difference in the audit of shareholders' equity or owners' equity between a publicly held corporation, you know, a publicly held corporation that the shares, yeah, in the security exchange, okay, share to the public, yeah, publicly held corporation, and a closely held corporation, yeah, close corporation. It means the shares not publicly or not in the securities exchange, okay? So most closely held corporation, close, yeah, most closely held corporation have few shareholders and only occasional stockholders equity transactions. So only few shareholder, yeah, close held corporation, okay? Few shareholder and maybe on the occasion transaction, yeah, in the stockholder equity. But publicly held corporations are more complex, okay? And verification of the following account is necessary. Now, what is it? account capital, we have to verify, okay, capital and common stocks transaction, paid-in capital in excess of par, retained earnings, and related dividends. Okay, so how about the overview of the account, yeah, provided in this flow? You can see the flow of transaction or the ledger of the shareholders' equity. There is a ledger capital stock, yeah, common stock or preferred stock, yeah. Okay, capital stock, paid-in capital, paid-in, wait, I would like to power the point. Paid-in capital in excess of par, yeah. Of course, cash in bank, yeah, dividend payable, and return earning, the ledgers. Okay, you can see that there are beginning balance, yeah, and the beginning balance and ending balance. We have to test the ending balance, test detail of ending balance, yeah. If how about the transaction? You can see in the capital stock and paid-in capital stock, yeah, there is a issue, yeah, on the credit part, yeah, a beginning balance. There is maybe issue on the current year, yeah, issue of stock, maybe redemption of stock, yeah, and about the dividend, yeah, dividend payable, declaration of dividend, yeah, you have to record to be the dividends payable, yeah. Maybe you have to payment of dividend, yeah, dividend declare first, yeah, declare and when to have to pay this dividend, okay. And the dividend usually take from the return earning, yeah. You can see the beginning balance of return earning, net earnings, yeah, there is a dividend declared and ending balance. So this is the flow of transaction of shareholders' equity. Okay. How about the our audit, our test, yeah, our audit of shareholders' equity? What is the important things? Okay. The first, yeah, you have to know that you have already know the first test is test of control, right? TOC. So you have to know what is the internal control, important control for shareholders' equity or owners' equity activities. Okay, first, proper authorization of transaction. Okay, because of their materiality, yeah, material, yeah, the transaction of the shareholders, yeah, equity, so need to a proper authorization. This transaction must be approved by the board of director, yeah. Even issuance of capital stock, repurchase of capital stock, and declaration of dividends, yeah, this transaction must be approved by the board of directors. Second, proper record keeping and segregation of duties. Internal control must ensure that actual owners of the stock are recognized in the corporate records, okay? Actual owners of the stock. The correct amount of dividend is paid to the stockholders owning the stock as the dividend record date, yeah? Only dividend record date. Okay, and the potential for misappropriation of assets is minimized. The third internal control should be independent register and stock transfer agent. Okay, what is it? Any company with stock listed on a securities exchange is required to engage an independent register, yeah, independent register, yeah, outside of the company, yeah, as a control to prevent the improper issue of stock certificates. And most large corporations also employ the services of a stock transfer agent, agent to maintain the stockholder records, including those documenting the transfer of stock owner. Okay, and many companies also use the transfer agent to disburse cash dividends, further improving internal control. Okay, this is the internal control. How about the internal control of shareholder equity? Okay, for all. How about the capital stock? Yeah, audit of capital stock and paid in capital. Auditors have four main concerns in auditing capital stock and paid in capital in excess of par. Okay, there are the audit objective. Yeah, existing capital stock. Our audit objective. Okay, we have to achieve completeness and accuracy. How we can do that existing capital stock transaction are recorded. This is the audit objective, our audit objective completeness. Existing capital stock transaction recorded. Recorded capital stock transaction occurred and are accurately recorded. So the audit objective is occurrence and accuracy. Okay. The third, that capital stock is accurately recorded. This means our audit objective is accuracy, and capital stock is properly presented and disclosed. So this is our objective, presentation and disclosure. Okay, this is four main concern. Okay, our for audit capital stock. How about the audit dividend? The emphasis in the audit of dividends is the transaction, rather than ending balance. Okay, the transaction of dividends, right? Okay, these are the most important transaction. Okay, the more important objective, our objective, accurate, completeness, accuracy. Okay, how about the first? Okay, recorded dividends occurred. Our audit objective, occurrence, that all transaction or dividends, recorded dividends occurred, exactly occurred, and existing dividends are recorded. So you can see the audit objective, the first one occurrence and the second is completeness. Recorded dividends is occurred and existing dividends are recorded. Okay, and the third, dividends are accurately recorded. Dividends are paid to stockholders that exist. You know, the audit objective is different, right? Accuracy, occurrence, dividends are paid to stockholders that exist. Okay, not fictive, the stockholders, not fictive, but really dividend paid to stockholders that exist. Occurrence. 5, the dividends payable are recorded, completeness, our audit objective, and dividend payable are accurately recorded, accuracy, and the last, dividend and dividends payable are properly aggregated and presented, and footnote disclosure are adequate and understandable. So it means our audit objective is presentation and disclosure. This is very important to in audit of dividend. Okay, how about audit of return earnings? yeah, audit of return earning. The most company, yeah, the only transaction involve return earnings are net earnings, for the year and dividend declare. Yeah, only the most companies. Okay, the transaction involve return earning only net earning for the year, uh, maybe profit or loss, and dividends declare. Yeah, but yeah, there may be in the changes in return earning, changes may include the correction, correction prior period earnings, maybe the correction to prior period adjustment and correction to appropriation of return earning. So you have to know about the audit of return earning that in accounting standard required proper presentation, return earning and disclose of information related return earning that what is the restricted, there is the restricted um, or maybe this restriction must be disclosed. Restriction of the payment of the dividend may be restricted from the regulator, from the government, from the securities exchange. You have to disclose. Disclose. So the restriction must be disclosed in the footnotes to the financial statement. Because to disclose the return earning, we have to disclose to the investor, to know about the restriction of the company from the regulator, from the government. Okay, I think this one is the presentation and disclosure. Okay, this the example, from the PT Indonesia. Okay, consolidated statement. You can see the presentation, the equity, equity. Underline, the red underline, I underline share capital, issued and paid, how many shares, and with par value, how much, the par value per share, and there's additional paid in capital, there is treasury share maybe, and of course return earning, return earning, there is appropriate and unappropriate return earning. This the presentation usually, you have to know, the presentation and disclosure. How about the disclosure? This is the example, a disclosure for the share capital and additional paid in capital. Okay, which is the number of share, the whose shareholders, maybe somebody, president commissioner have the how many number of shares, okay, and how many the percentage of ownership, and there is a public, the share for public, usually less than 5%, you have to disclose, in the notes to financial statement. Number share issued and fully paid, okay, and paid in capital. This is just kind of the presentation and disclosure, maybe more complex. Okay, the last before I close this presentation, I would like to give you the quiz. Okay, anybody ready? Okay, First, most closely held corporations have numerous transactions during the year for capital stock accounts. The answer true or false? Please could you respond the answer? What is the answer? Most closely held corporations have numerous transactions during the year for capital accounts. Is it true or false? Come on.
There are some answers on chat box. Bu Elly.
Which one? Chat. Oh, okay. Wait.
Yeah.
Okay. Yeah. False. Okay. Why? False. Yeah, that's right. Okay. Wait. Yeah. Most closely held corporations have numerous transactions during the year for capital stock account. Is the answer okay? False. Okay, yeah, that's good because close held corporation, yeah, have numerous, not numerous transaction. Okay. Now, the second quiz. The board of directors must authorize the amount of the dividend per share and the dates of record and payment of the dividend. Is it true or false?
Remember to put number, ya guys. 2, is it true or false?
Number 2, yeah, number 2. The board of directors must authorize the amount of the dividend per share and the dates of record and payment of the dividend. Is it true or false?
False.
Hmm? Come on, yeah, there's answer true and false, true, yeah. Okay, good, yeah, that's right. Yeah. Okay, thank you for the responses. Okay, yeah. The board of directors must authorize the amount of the dividends per share, the date of record, and payment of the dividend. Yeah, that's true. Okay, now the last quiz. Okay, the primary concern in determining whether retained earnings is correctly disclosed on the balance sheet is A, correct calculation of the net income or loss for the year. B, correct calculation of dividend payment for the year. C, whether prior period adjustments have been made correctly. Or D, whether there are many restrictions on the payment dividend. Okay. Can you see the question? The primary concern in determining whether retained earning, primary concern, okay? Yeah, in determining whether retained earning is correctly disclosed on the balance sheet is, okay, what? You, Igusti, say A, okay. Next. Come on. Who's C? Yeah. Okay. Who else? A. Clarito said A. Irfan Wahyu answered D. Okay. Anyone else? The primary concern, okay? To disclose, okay? Disclose return earning. Disclose, yeah. Disclose return earning on the balance sheet. Sabik say D, Najwan A, C. Come on, anyone else? A, B, C, or D? Okay, yeah. Thank you for the response. But the answer is D. Okay, because, the primary concern determine whether return earning is correctly disclosed on the balance sheet is, whether there are any restrictions. So that the last my last statement, okay, in the material. There are any restriction on the payment of dividend, restriction from the regulatory government, or securities exchange. The answer is D. Okay, thank you very much for the responses. Okay, I think, sorry. Okay, finish. Okay, thank you very much, Ibu Astri. Okay, give you back. Maybe Mr. Ralph will give the another problems case study. Okay, thank you very much for the time.
All right, you're very welcome, Bu Elly. Thank you for the valuable explanation. Okay, about audit dependence, audit and retained earnings, and also you give also some quiz, some questions to the students. All right, thank you. And then next, let's move on to Mr. Ralph. Hello, Mr. Ralph. Are you ready
Hello.
for your explanation?
Hello, ma'am. Good afternoon.
Good afternoon.
Is my voice audible?
Yes,
Good
it
afternoon.
is.
Thank you. Thank you, Ma'am Elly, for your discussion on the theory part of the shareholders' equity. And we will apply those theory on audit of shareholders' equity to the problems that we will have, sample problems that we have for the remaining time of this session. So I prepared 3 problems, just like what we had last time, so that we can fit in the problems within the given time. And for the last 2 problems last week, now we had problems 4 and 5. I will send out the computations and the answer to the problem so that you will have reference later on. And if you have questions, you can feel free to message us or contact with us if you have clarifications with the computations. Okay, so I'll share my screen. Is my screen okay? Is it visible now?
Yes, it is, Mr. Ralph.
Okay, thank you, ma'am. So this will be the second session of our online joint class with Telkom University in Data. And for us, we have our topic on auditing and assurance. So specifically for this afternoon, we have audit of shareholders' equity. So I will be discussing some problems on the transactions of shareholders' equity, of course, with those accounts, and also your retained earnings. And I'll try to insert some of the errors that probably might be considered in the computation. Okay, so of course, our learning objective is to apply audit procedures to establish assertions on equity balances, formulate audit adjustments to bring equity to correct balances, and to evaluate the appropriateness of the equity balance in the statement of financial position. Okay, so we will start now with our problems. Okay, so I hope this problem is visible on your end. Okay, let's go over the problem first. Okay, so Stone Company began operations on January 1, authorized where 120,000 shares of 10 par value ordinary shares and 240,000 shares of 10% 100 par value preference shares. The following transactions involving shareholders' equity occurred during the first year of operations. So we have 1, 2, 3, 4, 5, 6, 7, 8, 9 transactions that involves your equity accounts. Okay, so based on the preceding information that we have in your current year's transaction, we are going to calculate the following accounts. First is you are going to, of course, solve for preference shares. Second is the share premium, preference shares. The share premium is the other term for the additional paid in capital or the paid-in capital in excess of the par value. Okay, and then we have ordinary shares, the share premium ordinary shares, your retained earnings, and also your total shareholders' equity. Okay, so let's try to go over the first item first. You have there January 1 transaction. You issued 30,000 ordinary shares to the corporation promoters in exchange for land valued at 1,020,000 and services valued at 420,000. The property had cost the promoters 540 3 years before and was carried on the promoters' books at 300,000. Okay, so what are we going to? We'll have our entry on this. So first thing that you should do, of course, you're going to check also on what are the reasons why there is an issuance of shares. Okay, so in this case, for January 1, the shares were issued because of the purchase of land and the services that you actually receive. And because of those, you are going to issue in return or as form of payment to the seller of the land and the services. So what you did is to issue 30,000 ordinary shares. So let's try to go over and make journal entries for your January 1. Let me put this one here. January 1 transaction. So the land is or has a cost of 1,020,000, and then the 40,000, let us consider that one as an organization expense of 420,000. Okay, so these two are the ones that you receive through the issuance of your shares. So 1,020,000 and 420,000. So you actually issued the 30,000 shares. Remember that in all cases that ordinary shares are actually presented or recognized at par value. Okay, so considering that it is to be recorded at par value, how much should we credit in the account of ordinary shares? Okay, can you type in your answer? How much should be credited to ordinary share capital? 30,000 shares were issued and it should be reported at par. Okay, you can send your answers through the chat. Okay, 30,000 shares and par value of ordinary share. Okay, let me put it again on top. Okay, so that you can see the par value of the ordinary share and the number of shares issued for the purpose of the purchase of land in the services value. Okay, how much should be credited to your ordinary share capital for the January 1 transaction? Okay, so that is, yes, we have answer here. You have 30, okay, times 10, that's 300,000. So for us to have an initial record of ordinary share capital, this one should be recorded at 300,000. So as what we said, whatever is in excess of the par value will be recorded as share premium. Okay, so share premium for the ordinary share capital. I just tried to put in acronyms so that we can save up space. So the SP stands for share premium, ordinary share capital, that's OSC. Now, for us to balance our entry, how much should be allocated or how much is to be recorded under share premium, ordinary share capital? Please type in your answers. Land of 1,020,000, organization expense of 420, and then ordinary share capital 300. So the share premium should be, that's correct, 1,140,000. Okay, so this will be the amount to be recorded for the ordinary share capital and share premium ordinary share capital. Now, between these four items or elements of the financial statements, which among these are equity accounts? Is it land, organization expense, ordinary share capital, or share premium ordinary share capital? Which among these items are part of your equity account? Because later on, you will try to solve for the total shareholders' equity. Okay, so These are actually your ordinary share capital and share premium ordinary share capital. So please, yes, that's correct. So please make sure that you have to remember your items here. Okay, now let's proceed to February 23. Issued 60,000 preference shares with a par value of 100 per share. The shares were issued at a price of 150 and the company paid 450 to an agent for the selling of shares. Okay, so let's come up again with a journal entry on how to account for this transaction. Again, issued 60,000 preference shares with a par value of 100. The shares were issued at a price of 150 per share, and the company paid 450 to an agent for selling the shares. Okay, so what should be our entry here for February 23? Okay, so the first thing, of course, because issuance of shares, so you will actually receive cash in here. Okay, so 60,000, the amount of cash that you receive is 60,000 times the price of the share. Okay, remember that the proceeds in the issuance of shares is not based on the par value, but based on the issue price. So 60,000 times 150 pesos, 150, how much would that be? Let's put here February 23. How much cash is received? 60,000 times 150, how much will you get? 9 million pesos. Okay, so in this one, okay, 9 million pesos, that is your cash received. Okay, and then your preference share, let's put there PSC, that is recorded at par value, wherein you have 60,000 shares times 100 par value, which is equal to 6 million. Therefore, your share premium PSC is equal to 300,000. But take note that you have here a payment of 450. So this is actually somehow a payment to the selling of shares. So if you encounter this account, or if you encounter this kind of transaction, this 450 is actually an outflow in your part. However, what should be the debit? What should be accounted to be debited in order for you to allow this transaction? So if the amount is related to the selling of shares, the portion or the amount allocated will be charged to the share premium of your shares. Okay, so therefore, you have another entry for that one. So we will be charging it to your share premium, preference share capital, and credit it to cash, which is worth 450,000. Okay, so that would be your entry for February 23. Okay. However, you can also try to make one entry wherein you have to deduct automatically the amount of, you have their entry as well. You can automatically deduct the 450 from the 9 million as well as the 450 from the 3 million. However, the payment of 450 will not be explicitly stated in the journal entry. So it is better that you will go that you're going to present your journal entry in the payment of 450,000. Okay, so let us check all the items that are related to equity account. So you have your preference share capital, you have your share premium preference share capital, as well as well as the charge to your share premium preference share capital. Okay, now let's proceed to the next item. March 10, you sold 18,000 ordinary shares for 390 per share. Issue costs were 150. Okay, so the March 10 transaction is related to your February 3 transaction, only that the shares issued were ordinary shares. Okay, kindly try to prepare a journal entry for this transaction. Okay, sold 18,000 ordinary shares for 390 per share, and issue costs were 150. Okay. So I'll try to make an entry here so that you will have also your reference. So that is your cash, and then you have ordinary share capital and share premium ordinary share capital. So you have here 18,000 times 390, which is 18,000 times 390, which is equal to 7,020,000. Ordinary share capital of 180,000, and your share premium 6 million. And of course, as what we said, there is your issue cost, which will be charged to your share premium. Okay, so that is a deduction of 150 to your share premium, and also credit to cash 150,000. Okay, so if you look at the pattern of February 23 and March 10, okay, they are actually the same. Only that your type of share issued is different from the other transaction. So the February is for the preference, and for March that is ordinary share. Okay, so that is for March 10. Now let us have April 10. Okay, April 10 transaction, 24,000 ordinary shares were sold under share subscriptions at 450 per share. No shares are issued until a subscription contract is paid in full. No cash was received. Okay, because that there was no cash received, to which account should we charge this kind of transaction? Okay, anyone who has an idea, in case that you have this kind of transaction and based on this subscription, there was no cash received. Okay, so we are going to charge it in the subscription receivable. So that is correct. So we are going to debit in April 10. Okay, let me put this one here. April 10, subscriptions receivable. Okay, how much should be recorded as subscriptions receivable? So that is 24,000 shares times the price, which is equal to 450. 24,000 times 450, that is 10,800,000. Okay, and then of course we are going to credit your subscribed ordinary shares. So we cannot still record ordinary share capital because it is not yet fully paid. Okay, so instead of recording the ordinary share capital, we just still record subscribed ordinary shares. So that is still the same. The rule is the same. Number of shares times the par value. So that's 24,000 times 10, which gives you 240,000. And then the remaining will be credited to your share premium ordinary share capital, which is equal to 10,560,000. So that is your entry for your April 10 transaction. So let us check what items are included in the equity account. So of course you have the 10.8, the 240, and the 10.56. So all of these three are part of your equity accounts. Okay, so you may take a screenshot of the items later on, or we will provide you also with the annotated copies. Okay, next, let's go over July 14. July 14 exchanged 4,200 ordinary shares and 8,400 preference shares for a building with a fair value of 3,060,000. The building was originally purchased for 2,280,000 and by the investors, and has a book value of 1,320,000. In addition, 3,600 ordinary shares were sold for 1,440,000. So there is an additional item here. Okay, so what items were received in the July 14 transaction? You have two. Okay, what assets are received by the company in the July 14 transaction? Anyone can give me these two assets that were received by the company in the July 14 transaction? Okay, so we have answer here. Yes, correct. That is both building and cash. So we are going to record both the building and the cash. So that is a debit to cash and a debit to building. So let's put that one there. Cash is worth 1,440,000 and your building is worth 3,660,000, which is the fair value of the building. Sorry, that is 3,060,000. Let me check that one again. 3,060,000. So we recorded again the 3,060,000 and the 1,440,000. Okay, so that is for the July 14. But of course, by getting these accounts or these assets, what were used? Issuance of ordinary shares and preference shares. Okay, now for your ordinary share, how many ordinary shares were issued? The total ordinary shares issued during July 14. Can I get your answers here? How many ordinary shares were issued during the July 14 transaction? Can I get your answers? Okay, so we have, okay. What about the others? Anyone, any other answers? You have a total of 78. Okay. Okay. We obtained 7,800. That is correct. By adding your 4,200 ordinary shares and 3,600 ordinary shares. So these two will add up to 7,800. So because we're going to record it at par value, so that would be 7,800 times 10, which gives you 78,000 for ordinary share capital. Okay. Of course, there is actually excess of the par value. So we have also share premium, ordinary share capital. Okay. But the question here is, how much is the issue price of the ordinary share capital in July 14? Okay. Can I have try to go over the items? How much? The question here is, how much is the issue price of the ordinary share in July 14? How much is the issue price per share? Can I get your answers? Anyone? If you're shy, you can send directly your answer to me. That is totally okay. So just try to compute. How much, again, is the issue price of the ordinary share in July 14? You're not directly given with the amount, so you have to solve for that. What items should you consider for you to get the value of the issue price? Okay. Anyone? You're too shy to answer. Okay, sige. So you have, since the last statement gives you actually the total amount for the 3,600 ordinary shares, you can derive the value by dividing the cash proceeds by the number of the ordinary shares issued. Okay, can you please divide 1,440,000 divided by 3,600? How much will you get? 1,440,000 divided by 3,600. How much will you get? Okay, so your issue price in number 14 is equal to 1,440 divided by 36. That is equal to 400. That is correct. Okay, 400. So that means 400 is the issue price. You already recognize 10. So that means how much is allocated to the share premium if you already recognized 400. So the remaining 390 will be recorded as part of your share premium. So 7,800 times 390. Can I get your answers, please? 7,800 times 390. How much will you get? 7,800 times 390. How much would that be? So that is equal to 3,040,000. Okay, 3,042,000. That is correct. Thank you for your responses. Okay, but of course, there is, and it's not only ordinary share were issued, but also preference shares. Okay, preference share capital. Okay, let's go back to July 14. How many preference shares were issued in the July 14? So you're already given by that amount. That's 8,400 preference shares. So 8,400 preference shares, you have a par value for these preference shares amounting to 100, the amount of 100. So how much will be recorded for preference share capital? So that's 8,400 times 100. How much will you get? Okay, that is correct. Thank you for your responses. 84 times 100, that is equal to 840,000. And of course, the remaining balance, okay, will be credited to your share premium preference share capital. Okay, kindly please compute how much should be credited to share premium preference share capital, considering that we have these amounts in your debit and credit. Okay, please compute. Okay, so we have already an answer. Anyone can verify if the answer is also the same. We have 540,000 here. Anyone who also got the same 540,000? Okay, so 540,000 is actually correct. Okay, you can compute that one on your paper, or you can verify that one in your calculators. So that would be your transaction for the July 14 issuance and purchase of your building. Okay, so proceed to the next transaction, August 3. Okay, August 3 says that receive payments in full for half of the share subscriptions and payments on account on the rest of the subscription. Total cash received was 8,400,000. Share certificates were issued for the subscriptions paid in full. Okay, so if you are going to check your subscriptions last April 10 transaction, okay, you received the full amount on the half of the subscription. So that means out of the 24,000 ordinary shares subscribed, you receive the full amount for only 12,000 ordinary shares. Okay, and you actually receive 8,400,000. So of course, we are going to debit your cash. Okay, so that is August 3, debit cash for 8,400,000, and subscriptions receivable will be credited because you already collected this amount. But again, you will also reclassify your subscribed ordinary shares to your ordinary shares. So let's have subscribed, debit your subscriptions ordinary share to ordinary share capital. Okay, so that would be 240,000 divided by 2, because that is still recorded at par value. Okay, so that is 120,000. Okay, so that is based from your August 10 transaction, this one here. So let me try to put a line, 120, base it from here. Okay, so you recorded initially subscribed 240, but you just received half of it. So that's why we only reclassify half of the 240,000 to ordinary share capital. Okay. Next, you have November 2 transaction, issued 5,000 ordinary shares for an outstanding bank loan of 2,100,000, including accrued interest of 100,000. Stones ordinary shares are quoted at 410 per share on this day. Okay, so this is actually in payment of your bank loan. Okay, so of course you have to pay the market value of your loan. So let me put this one here, November 2. So you are going to credit or debit your loans payable. Let me put that one as LP at 2 million pesos. 2 million. And then you have also another debit, which is your interest payable, that is represented by IP, which is at 100,000. Okay. So there is issuance of shares amounting to 5,000 ordinary shares, which is to be recorded at par value. Okay, so ordinary share capital 5,000 times 10. So 5,000 times 10, that is equal to 50,000. Okay, the issue price of your shares is at 410. So the remaining 400 will be credited to share premium. Okay, so 5,000 times 400, which is equal to 2 million. Okay, so try to check whether your debit and credit is balanced. Okay, so your debit is at 2.1, but your credit side is only 2,050,000. So there is still remaining 50,000 in the credit side so that our entry will be balanced. What account should we consider in our journal entry in the November 2 transaction? Which account do you think shall we use as part of the journal entry in payment of your loan? Anyone? Any account that is appropriate for this kind of transaction? Okay, this is payment of loan in issuance of shares through issuance of shares. So we can use gain on extinguishment. Okay, so let's put that one there, gain on extinguishment. So that means you actually paid lesser than the carrying amount of your loan. Okay, so that's why there is gain on extinguishment. So let us check those items that are part of your equity. So OSC and share premium OSC. Okay. And of course, last we have December 31. So you already knew how much is the net income in your operations, which is equal to 3,600,000. So that's income summary, wherein we close your income summary to retained earnings at 3,600,000. And of course, there is declaration of dividend, that's a debit to RE, worth that is 2,380,000, and cash dividends payable, let's put that CDP, 2,380,000. So how did we come up with that 2,380,000? So let us put this one here. So for your preference shares, so if you go over your transactions for preference share capital, that is 60,000 plus 8,400 equals 68,400, and then times 10, which gives you 684,000. 684,000. Okay, there we go. So that's 68,400 times 10, giving you 68,400. And for your ordinary share capital, you have a lot of transactions for the ordinary share capital. So let's go over them. 30,000 shares. 18,000 shares, 7,800 shares, you have 24,000 shares, and then 5,000 shares. So this will give you a total of 84,800 times 20, which gives you a total of 1,696,000. So that will give you a total of 2,380,000. So that is the way you will solve for the declaration of your dividends. Okay, so considering that these items are part of your equity accounts, okay, let's try to answer how much is your preference shares. Okay, I'll try to flash all the transactions that we have here. Try to solve for the balance or ending balance of your preference share, and then try to answer or give your answer through the chat. How much is our preference share capital? You can put number 1 and then the letter of your answer or the amount that you computed. So that would be the amount of your preference share. So you have transaction in February 23. Okay, that's for preference share. And also in your July 14. That's all. You have also preference share capital there. So how much would be the preference share capital at the end of the year? How much? That is 6 million. Let me put this one here. 6 million plus 840,000. How much would that be? 6 million plus 840,000. So you have preference shares ending balance would be 6,840,000. So that is letter B for number 1. Okay. So maybe you are still answering the remaining items. Okay. Which if ever you have already computed for the first few items, you can send your answers through the chat. Okay. So what about your preference share premium for the preference shares? So you have transactions in, again, February 23 and also July 14. Again, how much is your share premium for preference shares in as of year end, December 31? So you have transactions in February 23 and July 14. Kindly compute how much would that be. So you have there net amount of 2,550,000. Okay, or you can actually consider 3 million minus 450,000, and then you add the 540,000. So your share premium preference for number 2 will be 3,090,000, which is equal to letter C. Okay. So verify your answers also on your papers. Maybe you're trying to compute as well. Verify your answers also. Next, you have number 3, ordinary shares. So you have several transactions involving ordinary shares. So let's go over January 1 transaction. That is 300,000 plus March 10 transaction, 180,000. And then you have your July 14 transaction, 78,000. You have August 3 transaction of 120,000. And you have November 2 transaction of 50,000. Okay, so let me write those. 300,000 plus 180,000 plus 78,000 plus 120,000 plus 50,000. So you will get a total or ending balance for ordinary shares worth 728,000, which is letter D. Okay, again, verify your answers there. For number 3, you have ordinary shares of 728,000. Okay. Next, share premium ordinary shares. So every time you have transactions specific to ordinary share, you also have the share premium for it. Okay. So you have 1,140,000 for January 1, 6,690,000 for February 23, April 10 of 10,560,000, and then you have July 14, 3,042,000, and loans payable November 2, 2 million. Okay, so that is share premium ordinary, which will yield an ending balance of 23,432,000. Okay, so that is number 4. That's still letter D. 23,432,000. Okay, kindly verify that one to your journal entries. Okay, so of course, for the retained earnings, we only have the last 2 transactions, which involve the income, the posting of the income, and the declaration of your dividends. So that is 3,600,000 less 2,380,000, which gives you ending balance of retained earnings 1,220,000. That is letter A. And after considering all of the transactions or all of the accounts that you have here, preference shares, share premium, ordinary share premium, retained earnings, you also need to consider your subscribed share and subtract your subscriptions receivable. So in effect, the total shareholders' equity that we have will be letter C, 33,030,000. Okay? So this would be your complete answer for the first problem. Okay, so I think I'll give you a tabular computation on this with the journal entries and also the summary of the transactions per account, so that you will see how the change in the accounts are presented, preference shares up to the total shareholders equity. But again, for your own reference, for this time, I'm just showing you your answers and quick journal entries for the problem number 1. Okay, so again, number 1, letter B, number 2, letter C, number 3, letter D, number 4, letter D, number 5, letter A, and number 6, letter C. So that is for your problem number 1. Okay. And then let's have this one, problem number 2. So maybe we can go over problems number 1 and 2, which are directly related to your shareholders' equity and retained earnings. So problem number 3 is actually correction of share-based compensation, which is actually have a short items or computation. So we can go over that one quick. Okay, so problem number 2, a CPA was engaged by Azkaban Company in 2024 to examine its books and records to make whatever corrections are necessary. An examination of the accounts discloses the following. A, dividends that had been declared on December 15 in 2022 and 2023 but had not been entered in the books until paid. B, improvements in buildings and equipment of 97,200 had been debited to expense at the end of April 2021. Improvements are estimated to have a 12-year life, and the company uses the straight line method in recording depreciation and computes depreciation to the nearest month. Okay, so here in your letter B, actually, this one, take note that this 97,200 has been debited to expense. But actually, this should be properly capitalized. So therefore, your income and also in effect the retained earnings should be properly corrected, because we have also to make prior period adjustments. As what we have discussed as well earlier in your theory, that there should be proper adjustments to make in order for us to establish the beginning balance of our retained earnings correctly. So the 97,200 should be allocated over the 12-year life and not to be expensed only for a certain year. So letter C, the physical inventory of merchandise had been overstated by 28,800 and 42,750 at the end of 2023. So in the correction of errors, actually, if there are misstatements in the ending inventory balance, so there will also be an effect to the net income. So if the ending inventory is overstated, what is the effect of the balance to your net income? Is it overstated or is it understated? Can I have your answers through the chat? Again, if the ending inventory balance is overstated at the end of the year, what is the effect to the current year's net income? Is it overstated also, or is it understated? Can I have your answers here through the chat? Overstated or understated? Okay, anyone? Again, for the question, if the ending inventory is overstated at the end of the year or of the period, okay, what is the effect to the current year's net income? Is it overstated or understated? Okay. Can I have your answers through the chat? Let me see. Over or under? Okay, we have answers here. What about the others? Over or understated? If you're shy, can directly message me through the Zoom chat. I think you can directly send or PM the message to me. Okay, yes. What about the others? Yes, overstated, overstated. So there is a direct relationship of the ending balance of the inventory, okay, and also to the net income. And yes, that's correct. We have also here additional information. The COGS will have actually the other inverse relationship. No? So if the ending inventory is over, the COGS is understated, but the income is also overstated. Okay, so that means there will be later on a proper adjustment for the 28,800 and the 42,750. Okay, so letter D. The merchandise inventories at the end of 2023 and 2024 did not include merchandise that was in transit to which the company had title. These shipments of 18,900 and 26,1 were recorded as purchases in January 2024 and 2025 respectively. So this one, there was an error or the inventory had not been included. However, it was actually corrected. Remember that your inventory accounts is a counterbalancing error. If there are any errors in your inventory, that error is a counterbalancing error. So what do we mean by counterbalancing errors? These counterbalancing errors will actually have a zero effect after the second year. So that means if the error occurred in year one, so it will have an effect in year two, but after the year two, the effect is already zero because the ending balance of the year one will be the beginning balance of year two, and thus the effect will zero out after the year two. So that's why it will correct itself. Okay, but of course, if you want to get the correct net income for the current year, it won't show you or it won't give you the correct net income. So there's also a need to adjust your differences in your ending balance. But again, it will self-correct. So that is in the case of inventory. Next is the company failed to record sales commission payable of 32,000 and 99 at the end of 2023 and 2024 respectively. So this will also have the same effect as what you had in your inventory, but this one is failed to record. So that means the expense is understated. So if expense is understated, the effect to the income is overstated. And also in number 7, you recognize to fail to recognize supplies on hand of 7,650 and 15,480. So this will understate income. So this just put it here, understate income. Understate net income, this will overstate net income. So there must be proper adjustment for this one. Okay, so let's try to correct your income for the years 2022, okay, 2023, and 2024. So based on the given, you have recorded income for the year 2022, which is at 252,000, a loss of 160,200 in year 2023, and a loss of 173,700 in 2024. So we obtained these amounts in your table. So you have 252, 160, 200, and 173, 700. Okay, so let's make some adjustments here. So first, let's have your depreciation. That is 97,200. Okay, so 97,200 divided by, 97,200 divided by 12. So there must be recorded depreciation for each year worth 8,100. Okay, so we have to properly deduct these amounts for 2022 to 2024. Okay, so that would give you or that would lead you to a correct income because you have not actually recognized your expense for the years 2022, 2024 because it was all expense in 2021. Okay, so you have to properly recognize that one. Next is you have your 28,800 and your 42,750. So as what we said, it will overstate the income. So we will subtract the amount, 28,800 for that year. It will carry out the effect to 2023. So the effect will be its inverse. So deduct 28,800 because it will overstate the income, and then add back your 28,800 because the effect now here is the overstatement in the beginning balance of the inventory. So that's why if you consider the two effects, it will have a zero effect. Okay, so same goes with 42,750. So we have to deduct this one here and then add back here. Okay. Next is your 32,400 sales commission payable, which is not recorded. So that is an expense. So we have to deduct that expense. So 32,400, and then here is also 32,400, and the 9,900. And the prepaid expense that you have here, 7,650 and 15,480. So that is added and then deducted here. Okay. And your 15,480. Okay. Okay. Based on these items, okay, can you please solve for the correct income and net loss of each year, 2022, 2023, and 2024, so that we can answer the first 3 questions for problem number 2. Okay, please solve 2022, 2023, and 2024 and type in your answers through the chat. Okay, so we have for 2022, number 1, that's letter A. What about the others? Yes, there's also letter A, so which is 215,100. Okay, let's put this one here. Okay. Try also to solve number for the years 2023 and 2024. Okay, so thank you for your responses. That is for number 1, 215,100. For number 2, that's 160,000 loss minus 81 plus 28,8 minus 42,750 minus 32,4 plus 7,650. You will have corrected loss of 207,000. That is correct, letter D. And lastly, for 2024, that's 173,700 less 18,000. Okay, yes. So we have here, yes, 215,1, 207,000, and 108,720. And that is correct. We have corrected loss of 2024, 108,720. So these are your answers for the first 3 questions. Okay, and of course, the last 2 will be the retained earnings. Okay, so these are related since we can get the running balance of your retained earnings for 2023 and 2024. So let's start first with the beginning balance of RE in 2022. So you have there 585,000. So that's January 1, 2022. Okay, so wherein you have there 585,000 here. So there will be errors and unrecorded depreciation, which we need to add back your 97,200 and subtract the 5,400 that is in excess of your in excess of the amount that you have expensed over the depreciation. Okay, so with this one, you will have your ending balance of 215,100. But again, you have dividends worth 139,500 for your 2017 dividend. So 2017, you will have ending balance for the dividends equal to 75,600. So this is your 12/31/2022. Okay, this is 2022. And then you try to consider the corrected net loss for 2023 and 2024. Okay, from that, you're going to deduct your loss. So at 207,000, and then dividends of 207,000. That is your loss in 2018, and also the declaration of your dividend in 2018, 139,500. So that would be your answer for the retained earnings in December 31, 2023. So that would give you 207,000 plus 139,500 less 75,600. So oops, let me check. 585 plus 97. Oh, sorry, let me correct this one first. So this is 676,800, 139,500. 573. Okay, so 537,300 less your net loss and your declaration of dividend, it will give you 405,900 as your changes in your items. And of course, with your net loss in 2019, so let's consider this one your 108,720. Ending balance would be 297,180. So this will be your answers for your 4 and 5. So that would give you letter A, 405,900, and letter D, 297,180. So this copy I will provide with you so that you can go over the items, considering that we have long computation. And then I will give you some sort of an Excel file maybe, or a PDF file that is with complete labels. Okay, so I think the problem 3, we can reserve this one, and I'll just give you the computations for problem number 3, since it's almost time. Okay, and again, if you have questions later on regarding our topic on shareholders equity or like in liabilities, you feel free to ask so that we can clarify your questions, especially those that are not crystal clear on your understanding. Okay, so that would be all on my end. Thank you so much for this opportunity to discuss with together with the Telkom University teachers and professors, as well as to the students of Telkom University. Thank you so much, ma'am.
Yeah,
right.
thank you, Ms. Rod.
Yeah, right. Thank you very much, Mr. Rolf, and also Bu Elly. Thanks for the explanation and insightful session for the second day or second session of our online join class. Yeah. So students, please give us reactions for this online join class. Or if you have such some questions, I mean, you could ask Bu Elly or sorry, Mr. Rolf. Okay, thank you for the reactions. And then if you have some questions, you may ask directly to our speakers today. Or you may also type in the chat box of Zoom. Okay, then. So, yeah. If there is no questions, so let's have a photo session together, yeah? Mr. Rolf and Bu Elly. Okay, so before we wrap up this online join class for second session, let's have a photo together. Okay, so could you please turn on the video and then let's have a photo time, a photo session, yeah? Thank you everyone for turning on your video. Hello everyone, it's nice meeting you here. Okay, so are you ready? So I'm going to count. 1, 2, 3. All right, one more time. Yeah, 1, 2, 3. Okay. Yeah. All right. So once again, thank you very much for Mr. Rolf and also Bu Elly, and also all students coming from Telkom University Indonesia and also University of San Agustin, the Philippines. Thank you. So I'll see you in the next session of online join class. Okay. So yeah, here I am going to share you the link, the feedback link. Yeah. Okay, so kindly fill out the feedback link before you, what is it? Yeah, before you leave this Zoom, yeah? Okay, so for Mr. Rolf and Bu Elly, if you have another agenda, you may leave this Zoom. Thank you very much, and I'll see you on another online join class.
Thank you, ma'am. Hope
Thank you. Thank
to
you
have
very
another
much.
engagement
Thank you,
with
Mr. Rob.
Telkom.
Yes.
Thank you, Ma'am
I
Elly. Thank
think quite
you.
difficult for students.
Yeah.
Should be quicker.
Yes,
Quick thinking.
ma'am.
Yeah, that's okay. Thank you. Thank you, Irfan. Thank you, Reyes, Maxino, Clarito. You're very active.
Thank you, Ibu Elly, and thank you, Mr. Raf.
Oh,
Hope we
thank you,
can,
Bu Novi.
You're
yeah, hopefully,
welcome. Goodbye, everyone.
yeah, hopefully we can collaborate again, yeah, in the
Yes,
next
ma'am. Yes,
upcoming online join class.
yes, ma'am.
Thanks,
We're
thank
looking forward
you.
to it. Goodbye, and thank you so much for the opportunity.
Yeah,
Have a great day.
thank you. Have a good day.
Yeah, thank you. Bye.
Thank you, students. We're going to end this session shortly. Yeah, thanks.